Welcome to Structural Shifts by Aperture, a bi-weekly show that radically reimagines the future of work, society, and business. We take a devil's advocate approach to exploring the massive shifts transforming our economies and our world, and our guests are not afraid to challenge the status quo. To learn more about Aperture, visit aperture.co. Today, your host, Ben Robinson, sits down with Marc Rubinstein, a former analyst and hedge fund manager who currently authors Net Interest, a weekly insight and analysis newsletter on the world of finance. Each note explores a theme currently trending in the sector, whether it's FinTech or economics or investment cycles. And today, you are going to hear about a little bit of everything. Marc and Ben discuss the history of equity research and where it's at now, whether current regulation is tilted too far against banks, the twofold challenge facing challenger banks, the past and future of embedded banking, the four key differences between investing in private companies versus public, the potential financial services game changers that could happen this year that people are not talking enough about, and more. In between writing Net Interest, Marc consults with corporates and investment firms and is an active angel investor in FinTech. Enjoy the episode.
So, Marc, thank you so much for agreeing to come on the Structural Shifts podcast. We're a really, really big fan of Net Interest, and so we feel very, very privileged to have you on the show. If you don't mind, can we start by just you briefly introducing yourself and giving us a short summary of your career so far, just because I think that will be relevant. I think we can use parts of your career to frame some of this discussion.
Sure. Well, no, thanks, Ben. It's great to be on. So I've been in and around financial services for 25 years. I started as an equity research analyst, analyzing banks. I spent 12 years doing that. I spent 10 years investing in banks as a partner at a hedge fund, exclusively focused on financial services stocks globally, publicly traded, long and short. And then since winding that fund up in 2016, I've looked at financial services out of sheer interest. It's something that it's difficult to shake off. And so that's basically it in a nutshell.
Good. Okay, so we're going to pick up on different aspects of that. But I wanted to start with the equity research part, because one of the newsletters that I most enjoyed, I mean, they're all brilliant, but one of the ones I've most enjoyed, just because it had personal resonance for me, because I was once an equity researcher, was the one where you talked about the history of equity research. And, if I were to summarize, I mean, if you don't mind, maybe you can just talk a bit about how sell-side equity research works, because it is kind of a strange model, right? Where,
yep.
Fund managers have access a lot of times to internal research, but yet they source it from a third party. That third party doesn't charge directly for that research. So it's kind of a strange model. But so if you don't mind just sort of talking about sell-side equity research and also how it's changed, right? Because I think, if I were to put it crudely, it's gone from a sort of really well-paid, really highly solicited job to something which is not that anymore, right?
So I started out as an equity research analyst in the mid-90s, and I was not particularly familiar with it as a professional opportunity. It wasn't something that I, at college, realized that it's something that I wanted to do. I wanted to go into finance, and I participated in a graduate training scheme at a bank, Barclays Bank. It was a subsidiary, the investment banking subsidiary of Barclays at the time. And went through various placements across the bank, not dissimilar to the way graduate training programs work today. I ought to say, though, any listeners that have watched the series Industry, it was nothing like that. But I ended up in equity research and spent, as I said earlier, 12 years there. Now, the way equity research was conducted then was very, very different from the way it was conducted prior to that and the way it's conducted today. Equity research emerged in the 1960s, 1970s as an add-on to the core brokerage business that brokers offered their clients. At the time, commissions were very, very heavily regulated, and the only way to compete was through ancillary services. And so brokers offered equity research as one of those ancillary services. They gave it away for free. It was a marketing device in order to attract brokerage business. And that was the case when I entered as well. At around the time, so we're going into the 90s, into the late 90s and early 2000s, another side of the investment banking business was booming, and that was M&A and equity underwriting. it's very topical now to go back 20 years and look at the tech boom of 99, 2000, given the conditions we're currently seeing today. But the way it worked back then is that companies would want to IPO and they would choose their investment banks, not dissimilar today. And one of the features that they would look for in selecting their investment bank was the quality of the research that that investment bank produced. And so rather than exclusively being a ancillary business to the trading business, which was the case historically, increasingly research became an ancillary business to banking as well. And as a result of that, equity research attracted a new revenue stream and was therefore able to grow. And in the late 1990s, this business of equity research grew. Costs increased. A superstar culture emerged. The piece that you referenced, I talked in there about a telco analyst who worked at Smith Barney in New York called Grubman, and he wrote on telco stocks like AT&T. And he was coerced by his boss, Sandy Weil, who was the chief executive of Citigroup, to rethink his view. It was kind of a euphemism for upgrade it to a buy on one of the stocks under his coverage. 2000 came along. Elliot Spitzer, who was he was the Attorney General in New York, took a view that actually there was a massive conflict of interest at play here, and he tried to dismantle that construct within equity research. The problem is that the cost base was still there, and the cost base didn't have now a revenue stream to attach to. And so you had like an orphan kind of wandering around looking for a kind of a foster family. It was looking for this cost base was looking for a new revenue stream. For a short period, it stumbled upon proprietary trading. So period between 2001 probably and 2006, 2007, investments banks built very large prop trading businesses internally, and equity research was a feeder mechanism for some of the ideas that they would put on. And then the financial crisis happened and that business disappeared as well. Ultimately, that was also dismantled by regulators through Volcker Amendment to the Dodd-Frank Act of 2010. So throughout this entire history, you've had this kind of valuable resource, this guy, just inherently experts looking at companies and issuing investment recommendations through the process of research on those companies. Yet in and of itself, it was a business that found it very difficult to reflect a model that was able to pay it sufficiently. Which brings us to today, and you've had another bout of regulation. This was in Europe about three years ago, 2017. You had MiFID II, which required a kind of an unbundling going all the way back to the 60s, where this process started, where research was an ancillary to trading. Regulators in Europe came along and said, actually, there's a conflict inherent in this as well, certainly in the degree to which it's paid for by institutions. And yet again, the business has gone through a kind of an identity crisis, and that's really where we are today.
If you feel like it's been sort of hammered by three waves of regulation, right? So it's first Elliot Spitzer, then Volcker, now MiFID II. One of the things that's changed is, you said, I think in your newsletter, you talk about how much Grubman made, right? I think it was like he made like $50 million or something in the space of a few years, right? Which would be unheard of now. So pay packets have gone down. But the other thing that's notable is the amount or the volume of equity research, right? Which has dramatically changed. I mean, you talked about going to Credit Suisse, I think it was, investor meeting. There were like, hundreds of analysts there. I remember, going to like SAP investor meetings, there would be, 100 plus analysts in the room. And so clearly we went from a situation where there was, oversupply. Do you think we've now gone, we've tipped to the opposite situation where there's a lot of undersupply, particularly of smaller cap stocks?
For sure, there is an idea that there's an undersupply of research out there, that there's been certainly a shakeout within the industry. Now, it was arguably overpaid to begin with. Certainly Grubman, did he merit the millions of dollars that he accrued? Probably not. Almost certainly not. We've possibly, not from a compensation perspective, but from a resource allocation perspective to the industry, we may have undershot on the other side. And it's not dissimilar. Maybe the analogy here is the media, is the press. And actually, there's a lot of overlap. And I draw this out in that piece between what a very, very good equity analyst does and what an investigative reporter does.
Yeah.
And there's a public service here. There's a public good here. Certainly what the research analysts were doing. So Wirecard, very well-known fraud. Interestingly, the credit, rightly so, for uncovering that fraud has gone to a journalist, Dan McCrum at the Financial Times.
Yeah. But
there are other cases, and certainly there were a couple of analysts. Some of them didn't cover themselves in glory, but there were a couple of analysts who also got that right. And there's a kind of a public service to looking independently without being influenced by the companies themselves and the management of those companies, nor by other constituencies, for putting out independent research on companies, for doing the job.
But it's interesting you call it a public good, because it suffers from the same shortcomings of a public good, right? In the sense that, it's difficult to exclude access to that research once it's in the public domain. And me consuming it doesn't stop you consuming it. So in many ways, it does have the properties of a public good, which means it suffers from the free rider problem and in general sort of under provision, right?
Absolutely right. And in addition, it's difficult before the fact to know if it's any good or not.
Yes, true.
Clearly, the analyst report that said that Wirecard was a fraud, after the fact, we know was really very, very valuable research. The report, which would have arrived on the same day on the client's desk, which said, Wirecard is, a great company and it's got huge upside. Again, after the fact, we realize it's got, a negative value. But at the time, the decision rests on the recipient to discern between those two. And that's not easy. And it's not easy as well to know ultimately where the value is in this. There's a lot of noise out there.
I want to come back to Wirecard in the context of, bank regulation and whether it's, a level playing field. But just on this idea of, perhaps under provision of research, do you think that creates arbitrage opportunities? So, for example, do you think it's now easier to create alpha investing in small cap stocks because there's a sort of higher return on doing that research yourself, whereas before that was not the case?
I think yes. We can talk. There's some great. So, actually, just recently, there's two companies called Signal. Elon Musk tweeted quite recently that one should be buying Signal. He was a big proponent of Signal. Readers picked up the wrong signal. Actually, early on in the pandemic, the same thing happened with Zoom. There were two.
Yes, I remember
Zoom.
That, yeah.
Two companies. The point here is, the markets just aren't efficient. The markets are not efficient, and Signal and Zoom, are great recent examples of that. And to the extent that they're not efficient, research does have value, and those inefficiencies typically emerge the lower down the market cap curve one goes.
There's a quite high proportion, certainly relative to in the past, of small caps that no longer have any sell side equity coverage, right?
Yeah, that is right. And it's not great either. Now, the flip side is that some of it has shifted over to the buy side themselves.
Yes.
So the investment community, that was a trend that was already in place from the institutional perspective. But what we're now seeing, because of the ability to share ideas more freely through the internet and platforms like Twitter, and also dedicated platforms like SumZero, and the ability for individual investors or smaller emerging institutional investors to get access to infrastructure. Maybe they can't afford Bloomberg at $24,000 a year, but they can afford other apps and other facilities. That more research is being generated. And Twitter, and actually, this brings us back to the model, because it's quite interesting. So the old research model was, we'll give it away to everyone for free and we'll attract some revenue dollars through trading commissions. More recently, post MiFID II, that has translated into, we will just service, say, the top 100 customers who are prepared to pay for it. There's a trade-off now between generating thousands of dollars from 100 customers or via the internet, particularly where the market might be individual investors who, and whether this is cyclical or secular or not at this stage, I don't know, but certainly retail engagement in the market is increasing. They're not going to pay thousands of dollars for institutional research, but the quality of what's available on the internet is very, very high. And maybe they'll pay $20, $30 a month, and tens or hundreds of thousands of those. There's a good newsletter writer called, there's a number of good newsletter writers out there, but a number of them, they offer, in my view, institutional grade research, particularly in the technology space, and they charge $10, $20 a month for it. But they have hundreds of thousands, and actually it would be interesting to see their P&L against that of a traditional equity sell-side research business, given lower costs and broader reach.
Because I was actually going to highlight that as a second arbitrage opportunity, whether it's called that or not, right? Which is one might be there's more potential to make money from small caps than there was in the past. But the other one is, I think, I don't want to suggest that this is the model for net interest, but a bit where, you can almost crowdsource as almost as good or maybe even better in some cases research from the internet, as you put it, right? Which is, the sort of the bottom up, kind of organic production of research to fill the gap, right? Because I agree, and you see the same thing in investigative journalism and other content areas, right? Which is, your choices are either to pay a subscription for the FT or to subscribe newsletters, right? Because these things are sort of mushrooming. And, that's another phenomenon in a way that you're embodying, right? Which is, you publish your newsletter on Substack, and in some ways you're kind of contributing to this gap that's being left as equity research has become or is provided to a lesser extent than it was in the past.
Yeah, I think that's right, and it comes from just this. I don't like the word democratization that people use, but it certainly plays into that theme. Clearly the advantage that, and I remember when I was an equity research analyst, it was at BZW, which you mentioned, which was a subsidiary of Barclays, and I was looking at Swedish banks in 1996. They'd kind of emerged from a crisis. They'd been re-privatized. They'd been re-IPO'd. And there was a kind of a recovery theme in a way. And I stumbled upon, it's kind of the early days of the internet. We had access to the internet, but it wasn't, what was on there was difficult to find. There was no search. It's kind of the days before Google. And I kind of stumbled across a document from the Central Bank of Sweden, the Riksbank, which provided very interesting data on kind of banking volumes. It was faxed to me by somebody in Sweden. I was working at home. It was a Saturday. I was working at home. I couldn't read it because it was Swedish. There was no Google Translate. Well, didn't exist. Yeah. I ran around to my local bookstore, bought a Swedish English dictionary, translated this thing, put out a piece of research, on this finding that actually loan growth in Sweden based on this data was greater than anybody anticipated, and it was a hit. I'd stumbled across something, but it was purely informational, and clearly the friction to getting that information now is just non-existent. Everybody has all of the information all of the time. Hence, there's no arms race in place to get new sources of information, kind of alternative data sets. But what's happening now? That's all done. We know that's kind of what's happening now. Is the same things happening to analysis. Now people, again, through the ability to meet in the market square via whether it's Twitter or any other kind of platform, there might be a great analyst who's based in, I know there's a great equity research analyst who I rate called Scuttleblurb. He's based in Portland, Oregon, far from Wall Street. And there are people just all over the world, in India, in small towns in England, all over the world, all analyze it. So they've got the base level of information, and the degree of analysis they're doing now is institutional grade, and it's accessible.
It was just before the financial crisis that you switched from being a sell-side analyst to working for a hedge fund, if I'm right. Presumably that was a great time to have the ability to go short on banks. And I just wondered, when you were living through it, how evident was it kind of in advance of the crisis that it was coming? Could you presage that, we were going to have this big crash? Or was it really, it was as sort of sudden as unexpected to you as it was for the people that weren't as closely following the sector?
Yeah, it's a really interesting question. It would be easy for me to say, yes. I would say the way I would finesse it is, yes, we saw elements of it. But it's important to remember, somebody once said, causes run in packs. There's never a single cause. And I think I think it's lazy analysis, and I see it. and often politically motivated, for people to say the financial crisis was caused by X. And X could be, typically it correlates with one's political inclination. Yeah. X could be, greedy bankers, or X could be people borrowing too much, or X could be sloppy regulation, or X could be too much leverage at the banks, or whatever it might be. There's a whole range of reasons. And ultimately, it was the confluence of lots of those things that happened to create the crisis. Although I do look, although me and my colleagues identified some strands of it to have predicted the degree to which it all coalesced, at its nadir in kind of, let's say October 2008. I think that was difficult. That was difficult to predict. There's a reflexivity, but that's inevitable. There's a reflexivity to it. It happened. I remember vividly watching the debate in Washington around whether around passing the TARP bill. It was controversial, and I remember specifically, and it went down. But because it went down, the market went down, and so reflexivity, because the market went down, then when it came back for another reading, because the market had gone down, incentives had shifted, and so reflexivity, predicting kind of reflexivity in advance is difficult. Having said that, there were things we saw. So back in, we were short. I mean, back in 2006, we were short some subprime companies. In fact, I went back through I'm not a Facebook user anymore, but but when I cancelled Facebook, I downloaded all of my posts, and there was one post in July of 2007 where I'd cautioned about an impending financial crisis. We were short Fannie and Freddie and all the rest of it. And just an observation about investing broadly, and we can go into more detail on the crisis, but investing broadly, what's difficult is changing. It's incredibly difficult for any investor to change their mind. And I think there were a number who were negative. A lot stayed negative beyond March 2009. But the fascinating thing to me is those that they were kind of negative, and then they switched positive, and just taking a step back away from financial services, but generally, investors' ability, the very, very best investors, their ability to adapt to changing conditions like that continually, very, very difficult. And I think history is littered with investors who have got 2 or 3 calls right, but to be able to retain an element of persistence through those changing dynamics, very, very difficult.
Yeah, I think it could be a rabbit hole, but I would argue almost like the potentially the greatest of all investors, Warren Buffett, has not been able to adapt his strategy to some extent to the digital age, right? Because he's still buying sort of, asset-heavy companies with a lot of sort of supply-side economies of scale and so on, right? So I think it even happens to the best, which is, when there's a paradigm shift.
True. And to our conversation earlier about small cap, large cap, I mean, certainly his performance hasn't been as good in the recent past compared to prior periods in his history. Yeah. He's got longevity. Very difficult to compare him to any other investor, because I'm not sure there's any track record out there that's as long as his. But he made the point recently that, he actually made it in 99. He made a point. There's a great quote in 99 where he was talking about if he had $1 million to invest, he'd crush the market because of his ability to access small cap. But it could be a reflection on your point as well.
It might be both, because he actually wrote another great newsletter, right, about the curse of managing too much money, in a way, right, which is becomes harder and harder to achieve a return on much bigger sums.
Yeah, exactly. And that's another curse that I call it Zuckerman's curse. Gregory Zuckerman, who's a great writer, has written a number of books he's written 2 in particular about hedge fund managers, and they've been published. Clearly he's been attracted to them because they've been because of their profile, and their profile is a function of their performance. And therefore there's a direct line between them showing good performance and him writing a book. Typically, but actually, no, it's more nuanced than that. It's not just them having good performance, it's them having good performance and being big enough for him to notice. One of my favorite investors out there is Hayden Capital, a guy called Fred Liu, based in New York. He was up 222% last year, but he's small. Nobody knows he's not. Nobody knows of him. And the curse is that over a certain size, it's difficult to sustain that performance on an ongoing basis. Actually, it's worse than that, because typically the money, after a good year, the money then comes in. And if there's, I'm not saying investing is mean reverting, but certainly there's an element of it. Certainly it's difficult to sustain very, very good performance across multiple time periods.
Do you know what Zuckerman's next book is about? Just so we know in advance and get out.
It's a good question. I mean, the other one was on frackers. I feel bad because they're great. I've read them all. I mean, they're great books.
Yeah,
but no, it's the writing on the wall. The curse of Zuckerman.
I'm going to ask you a bit like the financial crisis question. I'm going to ask you another question, which is going to be, I think, impossible for you to answer, in retrospect, without any sort of cognitive biases and so on. But you wrote another newsletter which I really, really liked, which was called The End of Banking. How obvious was it now in retrospect that post-financial crisis, financial services was just not going to be the same again, right? Because profitability is not the same. It doesn't represent anywhere near the same size of, as a composition of the indexes in which it sits. And so it just seems like the financial crisis in a way was like, the peak. And it may be, as you said, it's maybe cyclical. It may be that in the future it becomes as big as it was and as profitable as it was. But certainly it seems much more structural, right? For the reasons that I think we can talk about now. But was it when did it become evident to you that the sector becomes sort of structurally less sexy in a way?
I'll be honest with you, it took me a long time. My mental model, I mentioned Swedish banks earlier. My mental model was that banks, and this had been true historically, and in my working memory through the Swedish banks, they went through a period of crisis. They'd be recapitalized. They'd come back to the market. Typically, they'd be a lot more conservative, and so underwriting would be tighter. They would then generate huge amounts of capital, and they'd recover. That there was a cyclicality inherent in the industry. They would crash. They'd be recapitalized, and they'd recover. And that was my mental model. I remember at the time being told, we talked about the tech boom from 20 years ago, 99, 2000. We've talked about that already. I remember in 2010, 2011. A strategist who'd experienced the tech boom. I mean, I experienced the tech boom as well, but I wasn't directly involved in it. I remember a strategist at a bank saying to me, he said, it takes a whole generation. It takes a generation. We have to cycle. The market has to cycle through a generation of investors to forget what happened, to forget the scars of the previous crisis for any kind of return to normality. And I didn't believe it. I said no, and so I was sanguine about the extent to which the market would recover. I underestimated a number of things. I underestimated, one, how low interest rates would stay for how long. Two, just and I often think actually for the investment banks, worse than 2000, for them and their long-term, from a strategic perspective, worse than the experience they suffered in 2007, 2008. How well they performed in 2009 hurt them longer term from a strategic perspective more, because the backlash was then huge. It was kind of the political, the disgust that they made so much money in 2009 hurt them, and that increased the scope of regulation, which neutered them for many, many years after that. So I underestimated regulation. And then, we can talk about disruption and it's difficult. I'm not sure, but I'm not sure that was, I'm not sure I underestimated that, but that was clearly another factor.
Yeah. Maybe let's unpack those things, right? Because I think interest rates, we won't know for a long time whether this is a structural or a cyclical factor, but it seems like the re-regulation of the banking is a much more structural thing. There's one other thing which I don't know if it's permanent or not, but you talk about it as governments inserting themselves into the cap table of banks, right? But this idea that they become almost like an arm of government in some ways, right? Because particularly during the COVID crisis, they were used to direct funding, and also they just don't have the same control they used to have over capital allocation. So again, I don't know if that's a structural or cyclical or temporary phenomenon, but it's certainly one of the things that's been sort of weighing on bank valuations. But the re-regulation part, I think, is probably much more structural. And the question I wanted to ask you about that is, I think we could probably talk about regulation in different buckets, right? So part was about making banks safer, part was about sort of introducing more transparency. But the part that I think is now looking a bit kind of controversial in a way, right, is all the regulation that's aimed at introducing more competition to banks, so PSD2, for example, it almost seems like that was mistimed, because I think what the regulators perhaps hadn't appreciated, because the lag, was that there's just been so much new competition from non-banking players, right? So I wonder almost whether, in hindsight, whether regulators would have still introduced some of the regulation they've done to introduce more competition into banking, because it seems like almost now not necessary. And in potentially even unfair. In your last newsletter, you talked about that letter from Anna Botin to the FT, and it's some of that I thought was quite justified. Some of that sort of criticism of recent regulation and the absence of a level playing field. So it's a long question, but do you think almost like some of that's some of the regulation now is tilted or was too far against the banks?
Yeah, I think it's a truism that regulators typically fight the last battle. And not just regulators. I think it's a response to, I mentioned earlier, my mental model for the period after the financial crisis was dictated by the last battle, which was Swedish banking crisis of mid-1990s. So, and regulators are the same. So they are very, very focused on fighting the last battle. And equally, I think it was a truism that whatever the cause of the next financial crisis, it was never going to be the same ingredients to the one we suffered in 2007, 2008, to 2009. By the same token, it's not clear that we're not talking about a financial crisis here. We're talking about talking about as you put it, a playing field. But certainly the combination of low interest rates and a playing field that's not level was very, very negative for the banks. And there was a degree to which maybe regulators understood that, maybe they didn't. If they understood it, maybe there was no political motivation to circumvent it, because there was this culture about wanting to punish the banks. But you're right, this point about they insert themselves. It's the role of any chief executive of any company is pretty much exclusively as capital allocation. And from an investor's perspective, looking at banks, if they don't have the capability to manage their own capital allocation, because regulators can come in. I listened to a debate recently between some not so much investors, there were sell-side analysts and market participants and representatives from the Bank of England. And the view of the Bank of England, and I don't think they're unique here, I think it's a view of many regulators that prevented their banks from paying out capital in March of 2020 was, well, it's only temporary. But we've spoken about scars and the degree to which scars can be left. And from now on, any investor that is investing in a bank understands that at any point, particularly given the capital framework that was put in place to protect banks from unknown. I mean, clearly a pandemic was an unknown, but that's what capital is there for. It's there to protect against unknowns. It's not to protect against unknowns except for a pandemic, or unknowns except it's all unknowns, whatever they might be. And so even with that in place, for them to come in and say, actually, we're going to take charge here of capital allocation, that sends out a very negative signal. And
plus they'd already introduced regulation to ensure that there were more buffers, that you had to protect against losses earlier, right, in the cycle. And so to some extent, it was almost like a double hit on their ability to allocate capital, right?
Exactly. So we'll see. So we'll see the extent to which there's still a view out there that the worst hasn't been. We haven't seen. There's a view out there that we haven't seen the worst. That maybe over 2021, when things begin to recover, small businesses will see unemployment. There is a view out there, but certainly, and the other thing is, again, it comes back to this point of reflexivity. Back in March, the regulators didn't anticipate, to be somewhat fair to them, the degree to which monetary policy would come in and fiscal policy would come in. But once they had come in, there was a degree of caution that was maybe unwarranted. And from the perspective, and again, they might argue, who cares? We're hurting some bank investors here, but who cares? But ultimately, from the perspective of a bank investor, there's some long-term issues here, and actually banking, the ultimate backstop, and it worked in 2007, 2008, actually 2009, is that investors, the private sector bails out the banks. The private sector puts more money in because it knows that actually at this point in time we can draw a line, and that future returns for that bank look positive. It would have been difficult actually for that to have taken place in 2020, given what had gone on before it, and given the things we've discussed about regulatory intervention. I think it would have been very difficult for banks to have raised capital in the private markets, and that would have been very negative.
Do you think that maybe things might change from here, in the sense that this is where I wanted to bring in Wirecard, in the sense that because the banks are so heavily regulated now and so closely scrutinized, that a lot of the scandals and fraud and impropriety is happening outside of the banking sector, in tech companies or shadow banking or areas of shadow banking. And do you think at some point the regulator is now going to change the direction of, or at least move its focus to all of those companies that are doing banking but aren't banks?
Whether it's going to happen or not, I don't know. And actually, shadow banking, don't forget, even in the last crisis, one thing. I said earlier, I'm going to contradict myself now talking about fighting the last battle. But some of the ingredients of that last battle were in the non-banking sector, were in the shadow bank.
True, yeah.
Subprime companies weren't regulated. And in the US, different regulatory requirements for thrifts, such as Washington Mutual, who played a game of regulatory arbitrage, choosing to be regulated by one regulator rather than a broad financial services regulator. The investment banks weren't regulated as banks. Lehman Brothers was regulated separately from, and as a result of the crisis, Goldman and Morgan Stanley became bank holding companies and became regulated as banks. So shadow banks and this kind of regulatory arbitrage was going on anyway. But you're right, it's going on now. And these payments companies, to all intents and purposes, some of what a payments company does is not dissimilar to what a bank does. And we saw that with Wirecard, actually. And hence, you mentioned Anna Baton's FT op-ed piece. Some of the consternation of bankers right now is that tech companies are getting away with stuff that they just wouldn't be able to get away with.
In every sense, right? In the sense that they don't have the same scrutiny, but they also, they don't even have the same. They don't have the same, to set aside the same level of capital, for example, to do the same business, right? So it's not just more scrutiny. It's also just it's not just a supervisory level playing field. It's actually an operating level playing field as well, right?
Yeah, that's right. And the issue here is not about financial stability per se. It's about the specific issue that Santander has, and UniCredit has mentioned it, and Jamie Dimon at JP Morgan has hinted at it as well. Is about data. And one could have made an argument back in 10 years ago that the entities with the most data, that banks have got more data, more valuable data. And if we rank, so I guess Amazon has got shopping data, Google has got search data, Facebook has got social data, some overlap between them. Banks have got financial data, and what data is more valuable than financial data? And yet they've been restricted, rightly, from their ability to monetize that. And I think the issue now is we're seeing this convergence of data, hence this degree of consternation about the degree to which the playing field is not level.
And the PSD2 bit as well, like it's not just that they have to share data if the customer says that's okay. It's that they're sharing data with customers that already have, in some ways, an advantage because they're already sort of more embedded in our lives, right? So it's, as you've made the point many times in your newsletters, if you control distribution in the digital age, you're in a much better position to create network effects and to reduce the cost of customer acquisition and so on than if you're a balance sheet provider. And so it's almost like it's a double whammy of sort of thinking you need to introduce more competition and forcing banks to share a really valuable asset with those people that are already better positioned to capitalize on data anyway and distribution.
Yeah. That's right. And banks, certainly some of the startup banks, some of the challenger banks are trying to exploit that idea about distribution but they don't have the distribution right now that the big banks have, and that's obviously an issue for them.
And so I'm really pleased you mentioned challenger banks, because one of the things I wanted to ask is, you know how people are talking about this COVID economy is like it's K-shaped, right? And the idea that so everything digital is booming and everything analog is suffering or faring really badly. And to some extent, you've seen that in the world of financial services and fintech. You talked about Square, which we can come back to in a second, as a company that's really shot up and really found more customers and been able to sort of benefit from the crisis. But challenger banks notably haven't. What do you put that down to?
Well, some of them have actually. So you're right. I did right. So some of them have. So Chime in the US has done very well through this period, but others haven't. I think that the biggest challenge singularly that these challenger banks face is their ability to acquire customers cheaply, and historically, and the right customers. There's some question mark as to the quality of Monzo's customers, let's say, and actually, to be fair to the company has provided disclosure in the past as to what the unit economics are on a customer that pays its salary account into its Monzo account, as distinct from a regular customer that maybe saw their friend has got Monzo, downloaded the app, and maybe actually isn't even an active user. I guess the problem with banking here is that a problem, which maybe is why it's different from other digital industries, is that there's a life cycle perspective whereby the customer becomes more profitable when he's a little bit older, and yet digital adoption tends to take place when they're younger. So the challenge for the challenger banks is twofold. One, it's, as I've mentioned, it's the ability to acquire customers cheaply. But the second, linked to the ability to capture revenue from them, is can they turn a millennial into, can they extract profitability, which is equivalent to what a typical bank customer profitability might be, or do they have to wait until that customer gets a bit older and kind of hits that profitability level, which would be typical in a kind of in a life cycle process.
Talking about customer acquisition costs, because I agree with you, that's the unit economics are really hard to manage if you paid loads and loads of money to acquire the customer. It costs a lot to acquire the customer, and then the sort of lifetime value is somewhat held up, right? In my view, at least, right? Which is, the ability to sort of upsell and cross-sell customers is hard in banking because we don't actually spend very much time on the banking apps. And so I sort of had, we sort of have this thesis that it's going to become much easier to embed banking in other channels than it is to sort of build a really, really profitable banking business going forward. Because, if you consider, social channels, for example, or e-commerce channels, we spend a lot of time in those, on those channels. And if you can introduce banking into the, at the point of sale, or if you can introduce banking in a social way, then, first of all, you have a low or even negative cost of customer acquisition, but then you also have that real ability to generate very high lifetime value because you have the customer spending a lot of time on the app, and therefore you have a lot of surface area in which to upsell and cross-sell. Where do you stand on that whole embedded banking discussion?
Yeah, I think that's right. I think that is right. I think one of the reasons why payments has been the most successfully penetrated area within financial services by startups and digital propositions is exactly this point, that the frequency of payments is infinitely higher than the frequency of mortgage application. Yeah. So that is right, and then we think, and I've thought about this in the context of insurance as well as banking, but in both cases, nobody wants. No, I mean, it's a utility. Nobody wants a mortgage. There's no tangible benefit. There's no tangible value in the mortgage itself. Nobody wants a mortgage. They want a home, and secondary to that is the financing of it. And equally, nobody wants a checking account. They want ultimately it is a payments mechanism. They want some facility to, it solves multiple jobs. One is to facilitate payments. One is as a store of liquidity. One is maybe as a conduit into savings, longer term savings. but the tangible value of the thing itself is low. And as you say, therefore, the appeal of embedded finance is very, very high. Now, there are issues around regulation and the ability to, and from a business perspective, the ability to scale. But from a consumer perspective, it makes perfect sense.
And do you think this is therefore the biggest threat to banks over the long term, which is, it becomes easier to embed finance in channels that have engagement than trying to create engagement in banking channels, and therefore, as you've talked about, the sort of split between what we might call distribution of financial services and I guess we could call it like the manufacturing of financial services becomes even more pronounced, and therefore, profits go one way and the other becomes more and more of a utility over time.
Yeah, it depends where. So one of the other features of banking is that each market is distinct. Because we're going back, there's a path dependence. Because we're going back hundreds of years, banking has evolved very, very differently across different markets. A mortgage in Switzerland is very, very different from a mortgage in the UK, for example. So Russia is an interesting case study. And this Sberbank, biggest bank in Russia, has brand value that banks across countries in Europe and in the US would envy. They have phenomenal brand value, has launched a marketplace where everything we were discussing earlier, it knows it's got the data and it's got the brand value. So it's got the data and the brand value. So it's offering a marketplace. So it's offering a marketplace to its customers via its app. So that's one approach. And everything we're nervous about, big tech companies in the US and countries in Western Europe, everything we're nervous about them achieving, Sberbank itself might be achieving that and is in competition to the tech companies in Russia because it's forging its own path there. So that's one market. It's a bit different, but you're right. Elsewhere, I often think about. I've written this in one of the newsletters that Goldman Sachs plus Apple is probably the biggest competitor. That combination of Goldman Sachs's back office, banking as a service infrastructure with Apple's consumer-facing distribution and brand value, that combination of both of those could be a bigger competitor to JP Morgan than Chime or any kind of startup fintech challenger bank.
There's a tendency to sort of conflate retail banking with banking in general, right? Because trust is so important, and as you say, right, once we move into wealth management, then you just don't see the same level of tech or fintech disruption. Once you move into wholesale banking, you don't see the same level of tech and fintech disruption. So I wonder, are we guilty sometimes of talking about retail banking as if it's all banking? And then the second point would be, because you're such a sort of student of financial services, I wonder, do we also fall in the trap of sort of thinking that these things, which look so disruptive, have actually played out many times before in sort of different guises, right? Because I was reading your thing about Visa before, and it's almost in a way, was Visa not embedded banking in a way, So I wonder, are we also so guilty of sort of thinking these are bigger trends than they really are, and they're actually sort of they come across and they happen quite regularly over the course of history, right, in cycles.
Yeah, it's such a good point. I think 100% I agree with that. I think there's nothing new under the sun. A lot of what we're seeing now, we've seen before in various guises. So you're right. So I did a deep dive on Visa recently. It's a fascinating story. The founder of Visa, Dee Hock, was so far ahead of his time in thinking about payments and the way in which payments simply reflect. Just to give some context, we're talking about the 1960s, where computers were the size of buildings, and he was thinking about payments, and most of the payments at the time was done on paper that was shuttled between banks, and he foresaw this system whereby payments were, he didn't use the phrase ones and zeros, but they were. He talked about alphanumeric data. That payments were simply alphanumeric data. He's written about all of this. He wrote. So Dee Hock, founder of Visa, he's 92 years old today. He founded Visa in the late 60s. Let's call it 1970. He was CEO until 1984, and he wrote a book in 1999 that was reissued in 2005. And he talks about he questions the need for banks. He says, if it's just alphanumeric data, why do we need banks and the payments? And he, at the time, knew nothing about crypto, knew nothing about digital currencies. But presently, he talks about a global currency. He talks about payments just taking place directly between consumer and merchant. Much of the functionality that Bitcoin potentially offers, or crypto more broadly potentially offers today. And he was talking about this in the 60s and 70s. Just to come back to your question, similarly, equally, he allowed J.C. Penney, which went bankrupt last year. It kind of came out, it went through a bankruptcy process in 2020. It's come through that now. But back in 1979, it was one of the three biggest retail merchants in the United States. It was so big, he said, well, let's bring it straight into the, let's introduce embedded finance. Let's bring it straight into the Visa ecosystem. But even before that, interestingly, it was companies like JCPenney that actually invented the credit card in the way now that, so now we think about kind of Shopify and everything that Shopify is doing with Stripe to embed finance at the point of sale in merchants. This was the big merchants. I guess what's changed is that you don't have to be big anymore, that because of these providers, because the cost of everything has gone down, the cost of storage, the cost of underwriting, the cost of everything has gone down. It's become more accessible for smaller companies to offer these things that the big companies have been offering since the 1950s, 1960s. So yes, there's nothing new under the sun. We can do, same with challenger banks. Egg, we've spoken about 2000.
Yeah.
Egg was a challenger bank that emerged in the UK with a not dissimilar model to the model of many challenger banks today, 20 plus years ago, 25 years ago. A lot of these models have appeared before, and we can earn. And one of the things that I try and do in net interest is look back through history, as you say, as a student of financial services, to learn from them and apply them to the situations we find ourselves in today.
Having said that, there is nothing new under the sun. I just want to get you on digital currencies, because that actually does seem like something which is more transformation. If you don't mind, can you briefly just describe what digital currency is? Because one of the things that when we talk about digital currencies, people get, I suppose, a bit confused about is, if I were to pay you some money now and I would just transfer it to you, that's in a way digital money. So what's the difference between just an electronic transfer of sterling versus digital sterling?
So I think the difference, there's three types of digital money broadly. One is crypto. So it's basically, it's got its own infrastructure and it's got its own coin. So like Bitcoin. Two is, we can talk about stable coins, which are, it's got its own infrastructure. So Facebook looks like it will launch any week now, actually, its own stable coin. It's got its own infrastructure, but it's stable in the sense that it's not its own coin. It's a US dollar or some other currency. And then the third type is a central bank digital currency, which is the central bank maintains the infrastructure. It is also a existing currency. Call it the US dollar. It's got those three types, and I think the difference is, so if we're talking about, I think your question referred to central bank digital currency. The difference is, if I give you a 20 pound note, it will have a serial number on it. So when I'm talking about a digital currency, when I'm paying you online, it won't have that serial number on it. So basically, I'm digitizing that £20 note. I'm digitizing that £20 note such that if I was to pay you £20, it would have a serial number attached to it, such that the regulators, the central banks, could then audit the trail of that currency the way they do with cash right now through digital system.
But isn't that the most important point for central bank digital currencies, which is it's about that ledger, and therefore it really calls into the question the extent to which you need banks to intermediate, right? Because if you can have your wallet directly with the central bank, if the central bank can disperse money to you directly, does it to some extent take away that role of banks as creating money supply and because I suppose to the earlier question about if we are going to see an increased split between distribution of financial services, manufacturing financial services, and the central banks kind of rising up to take a bigger share of the manufacturing. Well, I don't want to call it manufacturing, but the balance sheet aspect of financial services, because more will just sit directly on their ledger. Does that again squeeze the sort of traditional banking sector?
Yeah, no, so it might do. Absolutely. And one of the reasons why the central banks are being so cautious in rolling out central bank digital currencies. Everybody's looking at China. China is trialing central bank digital currencies right now. They've suggested that those trials will continue up until Beijing Winter Olympics in 2022. So we're not going to see anything launch until at least then, and that's in China. And similarly, Europe and various other central banks have said they're still studying it. And one of the things they're studying is exactly that, is that whether they should differentiate between retail central bank digital currency and wholesale. And one extreme would be retail, which is the picture you paint, which is that you and I have an account with the central bank, the same way that UBS has an account with the central bank, or Barclays has an account with the central bank. We have an account with the central bank and are therefore able to conduct ourselves without the need for banks.
Yeah, because I can just send you money from my wallet to your wallet, right?
Precisely, yeah. Exactly. And it's insured the way bank deposits are currently insured. Or they do it wholesale, and actually they maintain the role of banks. And again, it comes back to this idea of path dependence. It's quite interesting. D. Hock, talking about him again when he thinks about Visa, he's got this framework for looking at the world. He says, to understand anything, you have to think about the way it was. You have to think about the way it is. You have to think about the way it might be, and you have to think about the way it ought to be. And when he was thinking about Visa back in the early 70s, and they'll say today, actually, he's made this very clear in his book, that Visa, because it being created through his kind of organizational principles, it's not a panacea. It is not, and he lists in his book, and I quote him in my recent piece, some of the issues, some of the drawbacks, some of the flaws in the Visa model. And to come back to what we were talking about, the point applies here as well, is that there's a path dependence here, that it may be on a blank sheet of paper, we can devise this phenomenal new financial system.
Yeah.
And they did that in China. In China, they didn't have credit cards. They went straight from cash. So they didn't need credit cards. You get straight from cash to a digital wallet, and you cut out the middleman. That's very, very difficult when you've got vested interests that are cultural, political, that when people are used to a certain way of doing things, as they are in Europe and the US. You might be right. From a blank sheet of paper, if we could devise a financial system, we'd do it like this. But that's not, to use D. Hock's framing, that may be the way it ought to be, but we can't neglect the way it has been and the way it is. And therefore, it probably won't pan out like that.
I was going to ask you this question at the end, but I feel I need to sort of preempt it now, which is, you talked about Libra. And I just wonder, if you look ahead at 2021, what's the sort of most potentially game-changing thing that's going to happen in financial services that people aren't talking enough about? It feels like that might be Libra, right? Because in a way, they're going to roughshot over all those vested interests and introduce something that's going to potentially have the adoption of every Facebook user, which is, I don't know how many billion people, and it's kind of outside a single country jurisdiction, and it just seems massive. I'm wondering, are you going to write a newsletter on Libra, because it just seems such a big phenomenon?
Yes, I agree. I think it will be a big story of 2021. Riding roughshod, interestingly, they already watered it down. So initially, they put together a consortium which included financial services companies. There was a backlash from regulators, and so they watered it down, and the result today is something a little bit different. But yeah, no, I agree with you 100%. I think it's going to be a big story of 2021. But
it's still a currency that might be used to intermediate peer-to-peer and other transactions, and even all the vendors that sell through Facebook, right? Within the Facebook network, you might have a currency that sits independently of any fiat currency, or is that no?
So again, the only thing I would say here is the regulators do still have the capability to insert themselves. And we saw that. So in Brazil, WhatsApp, which is part of Facebook, launched a payments mechanism, and they'd spent a lot of time preparing it, launched it. Presumably at launch, they'd had the approval of the central bank because they'd spent a lot of time preparing it. But nevertheless, the central bank, once it saw it, changed their minds and shut it down. So the regulators still do have this power, which is, I guess, it's classic disruption. So Bitcoin has been operating at the margin, and interestingly, never really became a payment coin. So Coinbase, which is going to IPO this year, and started out as a payments. It started out as a payments system for Bitcoin, and there's a book that was released in December called Kings of Crypto about the story of Coinbase, and in it they talk about hiring somebody in order to acquire merchants that would accept Bitcoin, and he did a great job. He got all these merchants, he got multiple billion-dollar revenue companies, lots of merchants all lined up to accept Bitcoin, but consumers didn't want to spend their Bitcoin, and so they pivoted to a broker, and Bitcoin became less of a payment mechanism and more of an asset class, more of a commodity. So, but clearly that can change, but as I say, so it's tangential, classic disruption, and so it operates margin, and it can become mainstream.
Yeah, and I think the point, if I understand, is you're saying sort of Libra, first of all, whatever way in which it's envisaged that it will be used might change because of regulator, and it might change because the use case is different from the one that was envisaged, a bit like Bitcoin. I want to move on to a different topic now, which is private versus public investing, because to get to the sort of the latter part of your career, I think one of the things that you're doing now is you're doing some angel and private investing. I just wonder if you have any interesting observations about the difference between investing in public markets versus investing in private companies. And I suppose we'll come back to it as well, but I think it's relevant because companies seem to be staying private for so much longer than in the past. And it's almost like being expert in private investing is a more important sort of skill set than it was historically, we could potentially argue. So I wondered if you've got observations around that.
Yeah, so interestingly, 3 months ago, I might have agreed with your point about companies staying private for longer. I think what we've seen recently through the rise and the emergence of SPACs is that's not.
Oh, you preempted that, because I was going to ask if the SPAC is the vehicle to sort of, to get companies from private into public markets faster.
Yeah, no, I think yes, that they are. So
okay, so let's break this down to three sections, if you don't mind. So first of all, why worse? And maybe I don't think we've got the data to show it's changed yet, but why worse companies staying private for longer? Because it must have been because it was difficult to realize the value in public markets. So and how do SPACs do that? Why would a SPAC or a company taken to market through a SPAC have a higher valuation than a company that would have gone through an IPO process?
Yeah, so long term, it's not clear that. Long term, maybe that's just an inefficiency in them. In the short term, maybe that's an inefficiency in the market. Long term, it's not clear that the mechanism through which one comes to market has a bearing on one's long term valuation. But having said that, there are some structural differences in the process. The key one here being that when through the IPO process, management is not allowed through SEC guidelines to provide any projections on the future. So it's caveat emptor. The investors, and coming back to what we were talking about earlier in terms of equity research, one of the jobs that equity research analysts used to fulfill was to provide equity research at the time of the IPO. Now, it wasn't always independent, which is one of the issues why it was shut down, but there was a service provided nevertheless. Now that's not allowed. So now what will happen is the company will provide its own filing, and the institutional investor will have to peruse that filing, do their own due diligence, do their own work in order to take a view, but they will have they're given no steer as to what the projections are. The SPAC, as a merger, rather than an IPO, it's structured.
Do you mind just, because I'm not sure everybody knows what a SPAC is. I mean, I love the phrase that you put in your newsletter. You said the SPAC is a bit like the wardrobe is the portal to Narnia, complete with unicorns on the other side. So what did you mean by that? I mean, if you don't mind just spending a minute on what a SPAC is, because it's such a new phenomenon. I mean, it's there are not many people, maybe many people that don't know what it is. So.
Yeah, sure, that's fine. So a SPAC is a special purpose acquisition company, and what it is it's a pool of money that is raised by a sponsor, typically a well-known sponsor. Will raise several $100 million in cash. And the purpose of the cash and the role of the company that the cash sits in is to do an acquisition with a private company, to find a private company. Hence the analogy of Narnia. So public investors clearly are restricted to investing only in public companies. But if they were to buy a share in a SPAC, it's just a pool of cash. If they were to kind of hand some cash to the sponsor will then go through the wardrobe into the land of the private companies and find a private company to merge with, bring it back out, and then all of a sudden you now, through the merger process, have got a share in a private company.
That is a great analogy, by the way. That's superb to describe what a SPAC is.
And just to finish off what I was talking about earlier, and the difference is, and it's slightly arcane, it's kind of regulatory, but the merger process enables the company to provide projections. So the guy on our side of the wardrobe, when the sponsor comes back out with his private company, can say, well, actually, in 2022, 23, 24, these are our projections. What do you think? And at that stage, he can either kind of roll with it, or he can sell, because maybe it wasn't what he wanted as a public market investor, so he can sell, but he's kind of got that right.
So you think this sort of recent last 20-year phenomenon of more companies staying private may be addressed through the SPAC, because it does two things essentially, if I understand rightly. Firstly, it reduces a lot of the friction and cost of going public, because I can't remember how much an IPO costs, but it's a lot, right? You pay in fees, I think it's like 4 or 5%, is it, that you pay to the investment bank?
It could be even higher, actually, yeah.
So there isn't that big cost. There isn't the sort of, I don't know how many months it takes to IPO, but it reduces the friction, the cost, the time to go public. Plus, also through being able to share projections with the market, arguably, and I think this is the bit that you're talking about, which is not as yet there isn't the data, but arguably it enables you to achieve a high valuation, which is because I guess there are the two reasons why people stay public for longer, right? One, they didn't feel they could achieve the valuation that they deemed appropriate in the public market, or they were just put off by the time and the cost and the friction. That's right. And also and the third reason is the private market was rich with capital. So why would they? But that bit hasn't changed, has it?
That bit hasn't changed. But you're seeing even in the public, interestingly, recently, so Lemonade is a FinTech. It's an insurance company that was founded on a kind of a digital platform, and it was a SoftBank. So the SoftBank Vision Fund is one of the biggest venture capital backers out there. It was an investor in Lemonade. It went public in July of 2020. Actually, recently, already in 2021, it's raised fresh capital in the public markets at a valuation much, much higher than when it went public in the summer. And typically, normally, and that's an unusual occurrence in the public markets, normally that would take place in the private markets. There'd be a funding round, even 6 months after the last one. It's more unusual in the public markets. So it feels like there's a kind of convergence between, maybe it's cyclical just because of where valuations are, but it feels like there's a kind of convergence between some of the behaviors that were typically the case in private markets and in public markets.
I suppose you could argue companies like Tesla wouldn't achieve a richer valuation on the private market than they could in the public market. But do you think also some of the stuff that couldn't IPO because it didn't come under the same level of scrutiny would do so through a SPAC?
Yeah, I think that's right. Some pushback about SPACs is people have talked about us being in a SPAC bubble, and inevitably there'll be a lot of poor companies that are coming through that wardrobe, that sneaking through that when the as Buffett says, when the tide goes out. Yeah, we'll see who's swimming naked.
I think probably we've run out of time to talk about Robinhood and that whole phenomenon of kind of, the sort of gamification of stock market investing. But I just wonder if you had any other observations just from your practice as a public and a private investor? The kinds of things you look for in companies that you didn't historically, or whether it's very similar.
Well, no, it's really very different. I mean, the level of it's very, very different investing in private companies from investing in public companies. For one, probably four key differences. One is the level of transparency, which is much, much higher on the private side than in the public side. Two is, and this is an interesting point, two is volatility. So a lot of people inherently don't like volatility. And I think one of the attractions of private market investing is that they only get revalued when there's a funding round. And so kind of right now it's not an issue because in the markets we're only seeing upward volatility with everything going up. But I think there was a kind of a degree of, think back to March, April of 2020 when there was a lot of not such good volatility in the markets. I think there was a degree of comfort around private holdings, which, whether it is the Robinhood app or whatever broker one is using, one's not seeing kind of the daily volatility of valuations in private holdings that they are in public. That's a difference. Kind of it's behavioral difference. Another difference is the third is the structure. Very, very important as a private investor to be comfortable with the structure of the holding. When you buy a share in Apple, it's a share in Apple. It's pari passu with all the other shares in Apple. That's not necessarily the case with private companies where there are different classes of shares. So it's something that as an ex-public investor gone private, I certainly had to learn about. And the final point, which is just that you're in the room. I mean, it's I can write a newsletter about Jamie Dimon at JP Morgan. He may or may not read it. He may or may not do anything about it. Probably,
I think he subscribes to it, doesn't he?
Well, probably he won't do either. But to just kind of be involved in, it's just a great experience being involved in a private company.
Yeah, and I think it's that last point, which is you have the ability to sort of make your own weather in a way, right? Because I always thought that was, for me, that's the key advantage of sort of angel investing, which is you don't just sort of invest the money and hope for the best. You can actually get involved and materially affect the return on that investment that you make.
Yeah, exactly. So
one question I want to ask you though, which is like the big downside, obviously, of private investing is liquidity. And it just sort of amazes me that we haven't seen more people enter the space for sort of the secondary market for private investing. What do you think that is?
There is a bit. So there are some crowdfunding platforms in the UK. Well, there's one crowdfunding platform in particular in the UK, Cedars, which offers secondary trading of its companies that it's crowdfunded for. But it's difficult actually because of the fact that, coming back to the point about structure, different classes of share. It's I see. I did another newsletter on fixed income markets, electronic trading in fixed income markets, which is much less developed than electronic trading in equity markets. The reason being is there are multiple fixed income instruments out there, whereas there's only one equity for most companies. There's only one equity, and it's the same here with private. There's too many different classes of share with too many different terms there's no standardization.
So I've got two quick follow-on questions for you. One is, what's getting you really excited beyond Libra looking into 2021?
I think what's happening, I think embedded finance is fascinating. I think what's happening broadly, just the acceleration we saw in 2020 around digital. I think what's happening broadly through payments mechanisms and going beyond payments, not payments as the hub. It used to be that the checking account was the anchor product for most banks, or potentially the mortgage. Actually, increasingly it's becoming payments, and that I think has all sorts of implications, whether it's around crypto, or Libra, or embedded finance. It's basically the common theme across all of those things.
And then the last question I want to ask you, which I think is going to be difficult, you may have to come back to us, which is, what's the best book that's ever been written about the financial services sector?
I'll probably have to. Oh, actually, Liar's Poker.
Yeah, that would have been my pick. Yeah, okay, good. So if anybody hasn't read Liar's Poker, you really, really should. Great. Marc, thank you so much for coming on the podcast. It was a great discussion, and I really appreciate you taking the time and keep up the good work with Net Interest, which is awesome. And if you don't subscribe to Net Interest, you really should. One fantastic deep dive into an aspect of financial services every Friday. So subscribe. Mark, if people want to subscribe, where do they find it?
Yeah, no, so netinterest.email. There's a page, netinterest.email.
Thanks so much again.
Thanks, Ben. No, great to be on. Thank you.
Thank you for listening to Structural Shifts by Aperture. To learn more about us, visit aperture.co. We are strategy for the networked age. Until next time.